environment, we are going to discuss as many factors as possible from 15 minutes. Okay, so let's start. Okay. Yesterday we have discussed till unemployment. So today we are going to discuss something called inflation and deflation. Okay. So what is inflation? Whenever prices of goods increase, okay, that is called abnormally. That is called inflation. Okay. So when can the inflation increase? Suppose there is a one distillery bottle and there are four buyers. Okay. There is a one distillery bottle and there are four buyers. So obviously what they will do? They will bid for that bottle. Like somebody will say, I will pay 20 rupees. Somebody else will say, no, I will pay 22 rupees. Somebody may say, I will pay 24 rupees. Somebody said 25 rupees. So whosoever pays more and how many articles are there? Like there is one bottle and there is one customer with the 25 rupees. So obviously he will sell to that person who will ask for 25 rupees. But suppose there are two bottles, so maybe that deal can be done at 23 rupees. Okay. So there is a continuous demand and supply bargaining is going in the market. And inflation is something where prices of goods increase more than in your income. Like let's take an example of inflation. Okay. Suppose there is an increment in your salary. Okay. Like every year we get an increment in your salary. So suppose sometime you are getting increment in your salary, and maybe that increment is 10%. You are very happy that you got 10% increment. Like your salary was 1 lakh rupees, but now it's 1 lakh 10,000 rupees. So you are very happy. But unfortunately, when you look at inflation in market, you will realize that inflation is actually 12%. Okay, just a hypothetical example. Suppose inflation is 12%. Very soon you realize you are actually in a minus. How you are a minus? Like you have got from 1 lakh to 110,000 salary. Then the increment in salary 10,000 you have gained or more. But still I am saying you are in a loss. Why I am saying a loss? That we need to understand. Suppose there is a 1 lakh, you have 1 lakh rupees. In that 1 lakh rupees, suppose all you have to buy is chocolate. Okay, and each chocolate costs 1,000 rupees. So when you go to market with that 1 lakh rupees, what you can buy? You can buy 100 chocolate. Okay, 1,000 rupees per chocolate. You have a 1 lakh rupees, and each chocolate costs 1,000 rupees. So you can go into market, you can buy 100 chocolates. Okay, so instead of chocolates, maybe that goods will change. Like you are buying a bike, or you are buying a provision store item, you are buying some fancy items or luxury item, whatever you want to buy. But ultimately, whatever like you want to spend that 1 lakh rupees, okay, either you will save money somewhere, or you will buy gold, or whatever way, but you will spend that 1 lakh. It's not that you just store 1 lakh rupees as it is. Okay, so what you will do, you will spend somewhere, or you will invest somewhere. Okay, but the price of investment or the price of saving has changed. How? So next year when you got that 1 lakh 10,000 salary, again you go to market, and you ask them like give me 110 chocolates. Okay, because what you remember is 1,000 rupees for one chocolate. Last year you bought after receiving last month you received 1 lakh salary and you went and you bought 100 chocolates. So this time you have 110,000 rupees. So obviously what do you expect? You will expect 110 chocolates. But the retailer will say, sorry sir, forget about buying 110 chocolates. You will not get even 100 chocolates this month. You will not get even 100 chocolates this month. This means what? Maybe this time you will get only 98 chocolates with that 110 lakh rupees. Okay, why? Because the prices has increased. So if your income and if it not it's your average income, that's not only your income. When average income is increasing by X%, but inflation or the increase in prices is by more than what is your increase in salary. That is what we call inflation. The purchasing power of money will decrease. Okay, the purchasing power of money will decrease. Like if you can take example of North American country. Okay, I forgot the name of country now, but there is a South American country where even to buy a vegetable now, you have to you have to take a money full of bag. Okay, even to buy a vegetable. Why? Because there is a huge inflation. Maybe it's a 700 to 800% inflation. Means the thing which you used to buy at 1 rupees, now you have to pay 1,000 rupees, 800 rupees for that same thing. So just imagine if you are buying say coriander coriander leaves, maybe you have to pay 10,000 rupees, okay, which was there at a 10 rupees once upon a time. Now you have to pay 10,000. Okay. So even to buy vegetable, you have to think why this happened. There are so many causes behind it. Like that country, okay, that country was completely dependent on oil, and somehow the government was uh, in the myth, or they have not realized how much currency they are printing. So whenever they felt, like last few a couple of years, there is a downfall for those countries which were completely dependent on oil export, because there is alternative shale gas as well. Due to environmental concern or due to environment awareness, people are, compared to they are using lesser oil, they require lesser oil. There is improvement in technology, hybrid vehicles, e-vehicles. Okay, there are so many reasons because of that. Wars in those countries. So due to various reasons, the demand for oil has decreased. Since the demand for oil has decreased, these countries are now facing shortage of money. So what they did, instead of increasing their export activity or becoming more competitive or diversifying their activities, okay, rather than being dependent on oil, they had an option to start something else. But instead of doing all those things, what they did, they printed currency. So if you continuously print currency, obviously that currency will go into the hand of people. So what happened now? Now there is a huge money available in the market. Okay, since there is a huge money available in the market, everybody has that money. Okay, everybody has that money. So to buy a same distillery water, what happened? Like somebody is saying 20 rupees, like the price was 20 rupees. But there are people, since there is a shortage of goods, okay, resources will always be shortage. Since there are less number of water bottles, what they are doing now, they are ready to pay even a 5,000 rupees for such safe water, because there are people who are having money with them. Since government has printed more currency, government has distributed more currency than what economy demands or what economy requires. Okay, and since there is a huge currency, people now have a huge money, and they are ready to pay any price. They are ready to pay any price whenever there is a competition. Okay, that's why I said even to buy a vegetable, maybe you have to take a bag full of money. Okay, so there are various reasons for inflation, but just with this case study, we can understand what is inflation. Inflation is increase in prices, or there can be a percentage. It's not inflation is always a negative one. Definitely, we need inflation. We need increase in prices, but that should be under control. Like in India's case, there is something called FRBM, Fiscal Responsibility and Budgetary Management. We are going to discuss fiscal responsibility and budgetary management, role of RBI, what is RBI, how RBI controls inflation, what is monetary policy. But just for the sake of understanding, now understand inflation is increasing prices, but inflation is not always negative. People, we want there should be increasing prices. If for like years together, if a farmer is selling tomato at 10 rupees kgs, okay, maybe they will not be happy. Definitely, this year they are selling at 10 rupees. Next year they want it to be 12 rupees. Then next year they want it to be 40, 15 rupees. So some inflation is good, or like under control. Like in India's case, what we have decided that we want inflation in between 2% to 4%. Okay, 2% to 6%. So average what we want to maintain is a 4%. If inflation is less than 2% or inflation is more than 6%, then definitely this is an alarming condition and we have to take action. This is what government has decided. So average which we are looking at inflation or ideal inflation if we want to maintain is a 4%. But there was a time even in India like when food inflation has gone to more than 10% or double. That means the prices of food has increased more than 10%, which is normally not an increase or not an increase in earning. Okay. Now okay. I think there was again a problem we have to restart. So let's start from cost push inflation. There can be various reasons for inflation. One is cost push inflation, where increase in cost, basic cost of goods leads to cost push inflation. Okay, there is a wage inflation. Wage inflation is there is increase in salaries of employees. There is a shortage. Maybe there is because of shortage of employees, or there is a higher demand for labor. received, during this COVID episode. Even last year there were a lot of there were many people who were hungry. They traveled thousands of kilometers without any vehicle. So there were so many reasons which led them to make sure that they never go back to these cities. Right? It's better to stay in their own city, and it's better to die among their own people. Okay, there is a lot of uncertainty, so that's why there are very few employees who are available in city area or the manufacturing hub areas. So now, since there is a shortage of labor, obviously the prices of labor has increased. Since prices of labor has increased, ultimately the cost of the price has increased, and ultimately the final MRPs have increased. Okay, imported inflation, whatever you import from some other country, that also leads to inflation. Okay, there is a famous case study between China and USA trade war. Okay, when Donald Trump was president, he has increased import duty on steel. Steel is a raw material, okay, raw material for a capital industry. So the prices of steel has increased, but still some of the people will have to import steel from China because of either their commitment or shortage of steel from other states. Okay, so they have imported steel from China, and ultimately, like it's not only for China but from all the countries, the price of steel has increased. Okay, even India used to export steel to USA. So price of steel has increased. Since price of steel has increased, now whatever USA makes from that steel, obviously the prices will increase. Like whatever will be the finished product, the price of finished product will increase because the price of raw material has increased. Okay, hyperinflation, inflation that that like we have discussed about hyperinflation in one of the South American countries. It's extreme inflation. That is, maybe 1,000% or something like that. Okay. So it is hyperinflation, which is considered a very dangerous state. I forgot the name of that South American country, but that is oil dependent country, and that leads to hyperinflation in those countries. Okay, core inflation, inflation rate excluding temporary factors. Okay, so they include only the permanent factors like oil and petrol, like food. They are permanent factors. Okay, so what they do, they consider inflation among only those things where inflation is permanent comparatively. Okay, they don't manipulate on daily basis. Okay, that is what we call core inflation, and there is a headline inflation. Headline inflation is inflation which includes everything. Core inflation which excludes oil, food, or something which is temporary. Okay. Demand pull inflation. Suppose there is increase in demand, that will also lead to, like, in terms of education sector, you can see now. Okay, those online classes or online system. Okay, or laptops. Like a lot of people are buying laptops, iPads because there is a demand. There is a demand for those things due to this sudden pandemic or due to social distancing or market shutdown. So what happened now? Now the prices of laptops or whichever equipment that helps for online education, online meetings, okay, online conversation, obviously their demand has increased. Okay, the internet demand has increased. Now people going for a Wi-Fi or some or other way they are taking internet. Okay, or the entertainment industry has boomed up. Okay, or you can see there is a demand for what we call okay, like whatever you can access, whatever web series, there is an increase in demand for web series. So why? Because people looking for some kind of entertainment which they can watch without spending much or without going outside. So this is how demand pull inflation. If there is increase in demand, obviously prices will increase. Okay, budget budget every year we hear no, in this budget government has announced this, government has announced that, but we many a time we neither find interesting nor we understand what is actually a budget. So budget is nothing but budget is like even in our home we make every month every year our budget. Okay, but we never write or we never publish our budget. That's why we never consider it as a budget. But government does the same thing, but they only publish it. That's why we know, on TV, on newspaper we read about the budget. So what is budget? Budget is nothing but planning for a next 1 year. For upcoming 1 year, what they do, they take some data from last year, some data from current year, and they make they make a plan for next year. Okay, this is called a budget. So what they how much money they are going to receive from different resources, tax resources, non-tax resources, and how much money they are going to spend on infrastructure, on salaries, okay, paying interest rate, or like there can be n number of expenses which government has. So it is just a planning part or a planning at a broader level, how much money we are going to get and how much money we are going to spend, how much money we are going to get and how much money we are going to spend on our state. That is called a budget. So there is something called revenue budget and capital budget. So revenue budget is whatever we are going to get. There is revenue and expenditure. Okay, revenue means whatever we are going to receive, maybe from taxes, government receives some money. From non-taxes, government receives some money. Okay, from capital receipt, we receive something. From capital expend or capital receipt and capital expenditure, there is some different headings which always makes a confusion. So revenue is something which we get from people, and expenditure is something which we spend on our economy. Okay, so there are two kind of revenue and two kind of expenditure. One is revenue receipt and one is revenue expenditure. Okay, so what is revenue receipt? Suppose something you receive for a one time, and once you receive that money, there is nothing creation of liability or creation of assets. Okay, suppose somebody has paid a taxes. Okay, you have received you received that money, that is revenue receipt. Okay, neither that money is decreasing your liability or increasing your assets. But suppose tomorrow you got a money, but you got money by selling, say, SBI Bank. Okay, but you got money, that's okay, but that is not a one time activity. This is something where you lost your assets. SBI Bank was your asset, the property of RBI, SBI Bank, or the investment you have put into SBI Bank. There are so many things through which you made this company or public sector company, but now you have sold this and you received money. That is something not which is not very healthy for any nation. Okay, but revenue asset is definitely very healthy for a nation. Suppose in our case, suppose you got some tomorrow of 50,000 rupees, but there can be two ways of getting 50,000 rupees. One, you went outside, you perform some activity and you received 50,000 as your salary. Okay, that transaction is done there. Okay, neither company can ask you to reverse that 50,000 rupees, nor you have any other option but to get that money. So you get that 50,000 rupees and you can spend wherever you want. And second way of making 50,000 rupees, you had gold in your home, you sold that gold and you made a 50,000 rupees. So there is a difference between both the revenue. Okay, here one revenue is called revenue receipt and second is called revenue expenditure. There is second is called capital receipt. Okay, in capital receipt, what you have done, you have received the money, but you lost your assets. Okay, revenue expenditure, again it's a one-time expenditure. Suppose you paid a salaries to your employees, that's it, that transaction is done there. But in a capital expenditure, you spend the money, but you bought gold. Okay, maybe you can say, I spent all 50,000 rupees, but in return you have at least you have made enough gold from that 50,000 rupees. Okay, which you can sell in the future, or that is also called as a liquid money, which you can sell anytime in the market. Okay, so there are different way government spends, like for whenever we receive a tax revenue, that is revenue receipt, non-tax revenue, where there is a planned revenue expenditure. Suppose government is constructing schools. Okay, government is constructing schools and that or roads, that requires obviously expenditure, but that is a capital expenditure. Here we are actually creating assets for nation. Okay, so it's not important to look at whether we are spending or we are earning. We are also interested, or we also have to calculate where we are spending and from where we are receiving money. That is called a revenue receipt or revenue expenditure, capital receipt or capital expenditure. In capital receipt and capital expenditure, either we create asset or we lose liability. Okay, either we create liability or we lose liability, either we create asset or we lose assets. So this is how we calculate about a budget form, or this is how we understand what is budget. Okay, there is something more to discuss. Let's see if possible we discuss in next lecture, or whatever we have, we can do the best. We will try to do that. Thank you. That it's from 10 to 11:30. I'm sorry. we were discussing about the budget. Uh, there is a revenue budget and capital budget. The revenue is a one-time activity. Either you receive money or you spend money. Either it is a revenue receipt or revenue expenditure. It is just a one-time activity. But whenever it is about the capital budget, whether it's a capital receipt or capital expenditure, it has a multiple entry or it has a long-term impact. Okay, like in capital receipt, we receive money by selling our assets, or maybe somebody else, like somebody is paying us because he has taken a loan from us. So this is something which is not actually earning for us. Okay, same in a capital expenditure, maybe we are spending a money, but we are spending a money to make assets, or maybe we borrowed from somebody, so we are repaying them loan. So it is actually not expenditure, but we are relieving ourselves from any kind of liability. So whenever there comes a word capital, it has to do with assets and liabilities. Okay, so this is a brief about budget and why we make a budget. We make a budget to ensure that whatever planning we do, whatever we planning to, we will come to know how much money we have, how much money we can spend, how much money we need to borrow. If there is suppose something called a fiscal deficit. Okay, fiscal deficit. We are going to see what is fiscal deficit and fiscal surplus. But here we can discuss here fiscal deficit actually. Fiscal deficit is whenever government is short of revenue, but there is a high expenditure. Okay, आमदनी अट्ठानी खर्चा रुपया. There is something like this. We can say that there is a fiscal deficit. So fiscal is financial. So whenever there is a financial deficit means having a like or in a minus. Okay, deficit is minus, surplus is positive. Okay, when your revenue is more than your expenditure, you can say is fiscal surplus. But whenever you have a more expenditure and less of a revenue, you call it a fiscal deficit. So there are various ways through which government can recover or can overcome the situation of fiscal deficit. Obviously, that is borrowing, okay, or printing a currency. But we have seen printing a currency is not a easy job, or it has a lot of negative effects that it increases inflation. So to avoid such inflation, what government does? Government normally borrow from people, or government can borrow from external sources. Okay, government can borrow from RBI, government can borrow from directly from people, like by releasing a bond. By some or other way, they try to manage between the same currency or the same capital which we already have in a market. See, if you print currency, obviously that currency is going to be in the public hand. So if there is 100 rupees already available in the market, and if you print, suppose we print another 20 rupees, so that means now people will have 120 rupees. But the resources on which they are going to spend, the resources will be same. So what will happen now? Prices of goods will increase by 20%. Since currency supply or money supply has increased by 20%, that is from 100 to 120 rupees. So what government does? Government mentions that 100 rupees as it is, and now they will try to get money from market itself. If suppose RBI tomorrow RBI increases the interest rate, what will happen if RBI increases the interest rate? Obviously, bank will increase the interest rate. Okay, because they are getting a better benefit. So the moment RBI increases the interest rate on saving, bank increases the interest on saving rate. Most of the people will invest in FD or saving account, and they will keep their money into bank. The moment the money goes into bank will give it to RBI because they are getting highest interest rate. Then RBI will borrow it to government, or government lend it to government. Well, then government will have a money, and government will recover its fiscal deficit. Since with that same 100 rupees, government is able to manage their affairs. Same time, people doesn't have a money with their in their hand, so obviously that will not lead to inflation. This is what happened in South American country, where government, instead of managing from a monetary or fiscal policy, what they have done, they have tried to manufacture, or they have tried to print the currency. Okay, that lead to hyperinflation. It's not only inflation; it leads to hyperinflation. Okay, as we have discussed, a fiscal deficit. There are two terms: fiscal deficit and fiscal surplus. Whenever there is a more revenue and less expenditure, that is called fiscal surplus. That means you have a surplus amount to spend. But fiscal deficit means you don't have enough money to manage your financial affairs. So obviously, what you have to do, you have to borrow from somewhere, or you have to arrange a money. Okay. So whenever there is called fiscal deficit. When आमदनी जाता है खर्चा is रुपया, this is called fiscal deficit. And in case of India, if you follow any of the budget, you will see almost like it's every year government is having fiscal deficit. But having fiscal deficit is also not a negative term. Okay, having a continuous fiscal deficit is also not a negative term as long as you are spending that money for capital expenditure. If it is a revenue expenditure, then obviously it is not recommended. But if it is for a fiscal deficit, in that situation, even a revenue deficit is accepted. Okay, so what do we mean by fiscal deficit, or what is the relationship between fiscal deficit and capital expenditure? Maybe government doesn't have money now, but they can borrow from somewhere and they can construct a school, they can construct a road, they can construct an airport. This will lead to increase in business. This will lead to ease of doing business. Okay, since there are multiple airports, obviously the transportation will increase. The transportation will be very fast. Suppose there are roads, obviously those tractors, those vehicles who are carrying goods, they can move very fast. Okay, there are schools. Obviously, ITR, or the knowledge of people will increase, interpretation skills will increase, and that will ultimately bring a lot of remittance for a nation. Or we can export more of the goods, or we can have a more of IPRs. Okay, intellectual property rights. So by some or other way, if you spend on capital expenditure, then obviously in the future we will have a more of assets, or we can make a more income from those capital expenditure. But if we are spending on revenue expenditure like paying interest rate, okay, or paying salaries, or whatever we are doing without creating any kind of assets, that in that condition fiscal deficit is very risky. But how we justify our fiscal deficit? Like India is always into fiscal deficit. Why we are always dependent on borrowing. Okay. So why this is happening? Because of there are various reasons. If you see highest expenditure which we incur every year, that is on paying interest rate. Okay, that's why we have introduced different kind of deficits. Okay, so one is a primary deficit. Okay, but even in a fiscal deficit, even in deficit, we have so many terms like primary deficit. So whenever we talk about a primary deficit, suppose there is a BJP government, they will say, okay, whatever interest we are paying now, this is something which is because of Congress has borrowed so many money from foreign countries. That's why we are paying interest rate, and this interest rate should not get counted into our performance. Okay, because we are not expending that much money, but still our budget is coming into a negative budget. So do one thing, minus all the money which we are paying as an interest rate, and then calculate our performance, whether we are in a fiscal deficit or surplus. Okay, so there is innovation, that is the primary deficit. Okay, there is something called revenue deficit. Okay, revenue deficit is a sheer loss of revenue, or there is a less of a revenue or more of expenditure. Okay, so there are capital expenditure, capital deficit. So there are various ways we calculate our deficit. Okay, so deficit is always, it's not negative term, but where you are spending or why you are facing a deficit, that is important. As long as you are spending a money to create it is always worth. Consider the same example at your level. Suppose you have a 1 lakh rupees. Suppose there are two students, one A and B. They both have 1 lakh rupees, and after 4 days they meet after their salary. They meet and they say like, I have 1 lakh rupees, but I spent on 1 lakh rupees. Second also says, I had a 1 lakh rupees, but I spent on 1 lakh rupees. First person said, where you spent? So maybe the first person will say, I spent for buying a clothes, goggle, shoes, or whatever, like going for a movie, buying some game, whatever they spend money for. But one person has spent money in this. Second person said, I also spent 1 lakh rupees, but I booked, I bought a gold. I bought a gold of 1 lakh rupees. Now they both don't have a single rupee in their account. But again, their ex don't have a single rupee in their account. But again, their expenditure is different. One has gone for a revenue expenditure where nothing can be made from that goggle, from that clothes. But second person who spent money on a gold, definitely he can sell that gold at any time. May not get an increment price, but at least he will get that 1 lakh rupees or 90,000 rupees, even if the price fall down. But still, there is a difference between expenditure. So if your nation is spending, if even if there is a deficit, but if your nation is spending on capital expenditure, then it is considered as a prospective state. And tomorrow they will have a more of assets. You must have played a game called a business plan game. Okay, so that business plan game, what we have to like a business game, something like that. So what we have to, we used to buy a different spots. Okay, we used to spend money, but we used to spend the money to buy a different spots. So finally, who wins the game? Who has most of the spots? It's not that somebody who has some more money, but who has the more of the spots, that person wins the game. Okay, so similarly, even if you are having a fiscal deficit, but you have made assets to for your economy, then obviously you will get returns from those assets. Okay, suppose tomorrow government has constructed a road, obviously they will collect tax on that. The moment they collect a tax on that, they will get a money. If there is increase in business activities because of good roads, government will get a more taxes. Okay, so some or other way government is going to get returns from those capital expenditure because we have created assets. Okay, now second slide is about money. What is money? That 100 rupees of note. Okay, if you remember or if you imagine that 100 rupees or 500 rupees note, what is that? It is actually paper. It doesn't have any value as long as you consider it as a currency. Now take that 500 rupees and go to US and buy something. Obviously, that is just a sheer paper. Okay, nobody will accept that 500 rupees except where we have exchange of money function. Okay. So here that 500 rupees, why we believe there is something called a fungible currency, okay, or legal tender. So like when Pradhan Mantri is announcing that from tomorrow onwards, on 8th November 2019, okay, when he was announcing that from tomorrow onwards, or after this 12 o'clock, 500 rupees, 100 rupees notes are not going to be 500 and 2000 rupees are not going to be legal tender. So what we mean by legal tender, our currency, our currency doesn't have any face value. Suppose tomorrow, government gives a silver currency, okay, a silver banda or so gold banda. What will happen? Even if you go to US, what will happen if somebody is not accepting that coin? What you will do? You will go to goldsmith and you will sell that gold coin or silver coin, and obviously you will get equal money. So there is something called a face value. Okay. So our paper note, if you go and sell it to some other country as a paper, you are not going to get a 500 rupees or 2000 rupees or 100 rupees. Okay. You will get even a 1 rupees. But why you steal value for that money or why you run for that money? Because of its face value. It's a fungible currency. Its face value, its face value in the sense, its face value in the sense, whatever you have written on that note, 500 rupees, you have a RBI governor signature saying that मैं धारक को 500 रुपए देने का वादा करता हूँ. That means if you go to RBI, okay, suppose nobody is accepting that 500 rupees, you can go to RBI and you can say to governor that you have said that you have signed here that whoever having this note, I will give him a 500 rupees note. I will give him a 500 rupees. That means whatever that worth 500 rupees, suppose any good which has a worth of 500 rupees, I will give you that if if you have this 500 rupees note. So this is what we call a face value. A fungible currency and non-fungible currency means suppose we have a 2000 rupees note and you give it to somebody and he gives you 500 rupees, four notes of 500 rupees. Okay, that is also same value. So fungible currency means if you divide a currency into four parts or whatever number of parts, but it has the same value. What is non-fungible? Suppose you have a diamond, or you have a diamond of say 1 kg, hypothetically. But tomorrow you decided to divide into four parts, 250 gram, 250 gram. Does it have an equal value what 1 kg of diamond has? Definitely not. The larger or the bigger the diamond will be, the higher will be the price. Okay, but it's not fungible currency. So function of money, we have understood what is money, what is face value of money. Okay, why we trust on that particular currency, what is the role of RBI, like why is RBI signs them. Okay, because RBI is under control of monetary policy. Okay, RBI is the government's bank. RBI is bankers' bank. Even banks have like ICICI. They also have a bank. Okay, that bank is RBI. You cannot directly go to RBI and deposit some money, or you can withdraw money from them. RBI is a bank of banks. Okay, RBI is a bank of government. Whenever government needs some money, they will go to bank, or whenever government want to deposit some money, they will go to banks take a loan from RBI. Whenever banks have a surplus money, they will deposit that money into RBI. So this is how RBI is control of money. That's why RBI governor signs on your note and says that मैं धारक को X फंड देने का वादा करता हूँ, वचन देता हूँ, ठीक है. So you will have RBI sign on every note. Okay. So this is about money. Why we need a money? We need a money because it serves certain functions. What are those functions? Store value, store of value. Suppose you have 10,000 rupees now, and maybe old notes. Okay, maybe old notes, and you have saved it, and now like in 2021 you come suddenly and you come with that same 2,000 rupees notes or 500 rupees notes, and you say, no, I have stored this value. I have stored this currency. Okay, and currency is currency. So even today I want the same currency, or I want a running currency or current currency instead of, or to replace with this old currency. Obviously government will deny you. Why? Because that currency doesn't have any face value. This currency has value because government considers it as a legal tender. Okay, until and unless government announce this is a currency which is a legal tender and we will accept that. Okay, that paper doesn't have any value. This paper gets value because government gives this it's a legal tender value. Okay, so whatever money you store today, maybe after 10 years, 50 years, you will get a same return because this is a store value of money. So when you have a currency with you and you want to store money, suppose you have 100 rupees today and you don't want to spend all 100 rupees, you want to spend only 50 rupees. So how you are going to save that 50 rupees? There are two ways. Either you can store goods or you can store that same currency. So what you do instead of saving on a good, because goods have a depreciation value. Okay, once suppose you buy a bike today and you go for selling after 2 years, maybe you will not get the equal price. But money has a store value. If you store that money, even after 2 years, you may get maybe there is some decrease in purchasing capacity, but at least you will have some kind of asset. So cash in hand, cash in bank. Obviously, these things have some kind of store value. So this is one function of money. Whenever you want to store something for a future, what you will store? You will store value or you will store money. Okay. Standard for deferred payment. Suppose tomorrow you have lent something to somebody, and after 10 years you are going for you are going to the person, as you say. Suppose I have not used your goods. Suppose you have sold a camera to person, and after 5 years you go to that person like pay me price for that camera you have bought it from me. And if that person says, okay, take your camera back, I don't need your camera. So definitely that will not be a business. So what you will ask? You will ask money with the interest, or the current price of the camera. Okay, in terms of monetary value. So here even you need some kind of currency. Okay, you cannot exchange between goods. Here you also need some kind of currency to exchange the goods. Okay, so initially we had a barter system. The question comes, why we switch from barter system to currency system? Okay, see, barter system, what used to happen? You used to give a bid and maybe they used to give a service for an entire year. Suppose there's a cutting salon. So you never used to pay 100 rupees for a cutting. What you used to pay? You used to pay 100 kg of meat, and for entire family, they will come for a cutting, hair cutting salon. But this caused a lot of inconvenience as goods has increased, services have increased. There are multiple things you are doing. Every time you are not dependent on barter, or every time maybe you don't have something to exchange. Like in case of India and British, when British came to India, there was nothing which they can sell to India, but there was so many things which they can buy from India. So in this situation, there is a lot of difficulty to go for exchange of goods. So in such situation, you actually go for currency. If you have a currency that provides ease of transaction. Okay, every time you have to find some kind of exchange article, and until unless you find exchange of article, same value of article, you will not be go for actual transaction. So here it provides ease of transaction. That's why we have invented currency. Okay, unit of account, obviously whatever you want to judge somebody, okay, or you want to value some company. So how you are going to value based on their assets? So how you convert that asset? You convert that asset into monetary terms. Then only will come to know this company is 3,000 rupees company, this company is 2,000 rupees company. Okay, exchange, as we have discussed, whenever you want to exchange something, like why we have shifted from barter to money, because it's a medium of exchange. Okay, it is very difficult to find a same article or worth of same worth article to exchange between two goods. So to overcome this problem, we have invented money. Okay. Next is who controls that money. Okay, who is the decision to decide how much money we need to from print, how much money we can print, or how much money we need to withdraw from market. These are the things which actually controlled by RBI. Okay, these are the things which are actually controlled by RBI. So this is a part of monetary policy. This is a part of monetary policy. Okay, so monetary policy and fiscal policy, there are two kind of policies which control a nation's economy. So monetary policy is whatever action that is taken by RBI, that is called monetary policy. And fiscal policy is whatever activity that is done by financial manager or government. Okay, finance minister or government, that is called fiscal policy. Okay, so let's see what are the functions of RBI. Monetary manager, obviously whatever in inflation is there. Like why there is inflation? Because there is surplus money available in the market. Okay, so RBI decides how much money they want to bring back to RBI, or if suppose there is deflation or there is a slowdown in the market. So what RBI does there? RBI spends money, or RBI gives money to market. Okay, or maybe they reduce the interest rate. The moment RBI reduce interest rate, what will happen? Banks will be interested to buy to get the money from RBI, because it's anyhow it's on the lower interest rate. If RBI is reducing interest rate and banks are taking interest loan from RBI, then obviously banks will also reduce their interest rate. If banks reduce their interest rate, obviously people will be more interested to buy a car to start their own business, because there is low interest rate. Okay, you get a call repeatedly that said interest rate बहुत कम हुआ है, do you want to take a car loan, do you want to take a home loan, something like that. So people will start taking a loan from banks, and since people are taking a loan from banks, there will be more money available in the market. Since there is more money available in the market, people are starting their new businesses. This will lead to more employment, this will lead to more expenditure, this will lead to more demand, and that is how economy will have a better prospect. But if there is no money in the market, people are not starting a business, there is no employment, obviously economy is going to slow down. So target of monetary policy is to ensure there should not be a slowdown in the market. There should not be slowdown in the market. There should not be high inflation. There should be controlled inflation. This is the job of RBI. As I said, financial system manager, okay, they ensure there should be enough availability of finance, or enough availability of money in the market. Foreign exchange manager, obviously whatever foreign exchange we have, this is stored by RBI. It's dollar, euro, or whatever that currency we have in India. This is all stored or all exchanged by RBI. If somebody from a foreign country wants to come into Indian market and they want to start their business, obviously they will first bring a dollar or whatever currency they have. They will exchange with RBI, and then they can spend that money into Indian market. Currency manager, as we said, what amount we have to pay, how much money we require in the market. That everything is decided by RBI. Okay, payment system, whenever we have to pay some other country or whatever balance sheet we have to maintain. Okay, about import and export, that is again maintained by RBI. Bankers bank, as I said, whenever banks need a money, obviously whenever banks are short of money, they will go to RBI, or whenever they have a surplus money. Since they have a surplus money and they anyhow this money belongs to depositor, and they have committed that depositor will get X amount of interest rate. So they don't want money to be idle at their bank. So what they will do? They will deposit the same money with RBI, and RBI will give them a same interest rate or some interest rate. Okay, so bank will decide different. There are different monetary policies. There are different banks to government, banker to government. Okay, banker to government, again, whenever government needs money, they will go to RBI. Whenever government has a surplus money, they will go to RBI. Okay, RBI has a different tools like repo rate, reverse repo rate, statutory liquidity ratio. Okay, so there are cash liquidity ratio. There are many ways through which RBI ensures there should be a proper working of banks. Like even in the case of the Harshad Mehta case, you must have understood role of RBI governor of that time. Okay, who was having a continuously or watch on Harshad Mehta. Okay, why? Because it is manually inflating the economic growth or manually inflating the share market demand. Okay, actually there is no demand for shares, particular shares, but with the use of emotions or with the use of rumors, they are actually increasing the price of shares. That people are paying more for the share, which actually has nothing to do with on ground reality. Okay, so to overcome this or to look after these things, RBI continuously work to ensure there should not be any slowdown, there should not be inflation in market, there should be enough liquidity available in the market when it required, and RBI also ensures whenever there is a hyperinflation or higher inflation is going, RBI sucks money or RBI takes money from a market and that deposit with themselves to ensure there should be shortage of money in the market and inflation should be controlled. Okay, this is a function of RBI. We have discussed about monetary policy and fiscal policy. Monetary policy is all the action which is taken by RBI to ensure there should be enough employment in the market. There should not be recession in the sense slowdown in economy. There should not be slowdown in economy. There should be control on inflation. Okay, and there should be enough availability of liquidity into market. So this is a part of monetary policy. Same thing. The target of fiscal policy and monetary policy is different, but the tools are different. Okay, maybe government is having a tool of increasing tax rate or decreasing tax rate, whereas RBI has increasing or decreasing the repo rate and reverse repo rate. So they have a different tools altogether. But the ultimate aim is to have